minutes. You'll notice that there is a question box in the meeting interface. If you have any questions or want to raise your hand about something, please click on the questions and submit it. We do have somebody monitoring that. Also, the handouts for this session are also available to be downloaded in the interface for the meeting. So hang on just a minute, we'll get started here right away. Again, welcome everybody. We're getting filled up here. The room is about 2/3 full, so we're going to be starting in just another minute. Again, there's a questions section of the GoToMeeting interface where you can submit a question if you have something during the presentation, as well as the handouts are available to be downloaded from the GoToMeeting interface. Okay, it's just now on the top of the hour. We're going to try to get started here in just a second. Again, everybody, there is a questions box on the GoToMeeting interface where you can submit a question during the conference if you have one. And there's also a handout section on the GoToMeeting interface where you can download this presentation in a PDF format. Okay, Tim, let's get started. Welcome, everybody. Thank you for joining us. This is going to be a webinar on the EPCRS part 1 we're doing. We're doing this in 2 parts. There'll be a second part presented later in the year that you'll get notified about. Basically, this is an overview and a little bit of an update. Our speakers today are Eileen Ferenzi and Tim McCutcheon. Many of you probably know one or both of these people. Eileen is the managing partner of Ferenzi Benefits Law Center, an employee benefits law firm in Atlanta, Georgia. Ms. Ferenzi advises clients on all types of employee benefit plans, particularly focusing her practice on qualified retirement plans, benefit issues and mergers and acquisitions, and advising third-party administrators of employee benefit programs on technical and practice issues. Having become an attorney after more than 10 years as a third-party administrator, she brings a unique and practical approach in her advice. She's a member of the state bars of Georgia and California and holds designations as a certified pension consultant from ASPA as well as an accredited pension administrator from NIPA. Tim McCutcheon is the publisher of ERISApedia.com and the president of Vermont Compliance Labs. Tim is also the founder of ftwilliam.com, the most innovative document and government forms provider in the industry. He wrote the first web-based 5500 forms package and introduced the first retirement plan document e-sign system. Tim is a member of the IRS Great Lakes TEGE Council and a former member of the Information Reporting Program Advisory Committee of the IRS. Prior to founding ERISApedia.com and ftwilliam.com, Tim practiced law, including counseling TPAs, financial service companies, and other benefit service providers regarding qualified plan product design and compliance. Tim received his JD cum laude from the University of Wisconsin-Madison. He is also a CPA and holds an MBA degree from the Kellogg School of Management at Northwestern University. So we're going to get started here now, and please remember you can download these slides. I'm your facilitator, Chuck Gouge, and the question board is monitored by Joanne Pacina. So please, as we go along, if you have a question, put it in the question box in the interface. We'll try to get to it during the conference. If not, we'll make sure we follow up with you after the conference. Take it away, Tim and Eileen.
So, hi everybody, good afternoon. Glad that you could join us. I guess I said afternoon because it's afternoon where I am out on the East Coast, but if you're actually on the West Coast, good morning. So the purpose of this session is going to be to talk about some of the real basic concepts of EPCRS. I know that when there's some topic out there that I don't know anything about and I go to seminars about it, people always seem to be starting in the middle with some assumption that I know something about the topic. And we wanted to give people an opportunity to sort of catch up with the way that the EPCRS program acts right now. So if you've never done anything with it before, this should help you as an introduction, and you'll be able to dive in with full flood and get going on this. So on that basis, unless you have something else to say, Tim?
No, I think that sums it up.
Okay, I'm going to dig right in then. So this is the introduction to EPCRS. EPCRS is an abbreviation for the Employee Plans Compliance Resolution Program. And this is a program basically that allows you to fix boo-boos that are made on retirement plans. It's a revenue procedure, and for those of you, again, who don't normally deal with this, a revenue procedure tends to be a type of cookbook for whatever it is that the IRS is trying to tell you. It is a procedure of how to go forward to do something. And so this revenue procedure, which is somewhat lengthy, tells you everything you need to know about sending in a case to the IRS or dealing with a case in self-correction. And I strongly recommend that everybody who's on the call pull that procedure and print it out and take a look at it and keep it on your desk and refer to it as errors come up, because it will really help you. So again, we're going to just deal with EPCRS sort of in generalities and in how to deal with it. Today, we're going to have a second session later on this year where we're going to talk about some of the finessing of the EPCRS process to really help your clients out. But this is the basic process. Okay, so again, the purpose of EPCRS is to help plan sponsors ensure that their plan stays in compliance with the various rules under the Internal Revenue Code and gives them a means by which they can correct the errors without losing the tax benefits of the qualified plan. Before EPCRS existed, if the IRS audited you and found an error, well, years and years ago, back in the Stone Ages, when we still had, covered wagons and things like that, the IRS would find an error and they'd discuss it with you and you'd fix it and everybody would go home happy. Then we went into a period of time, I guess it started pretty much in the 80s, where the IRS got much more concerned with raising revenue from all sources, including employee benefit plans. And at that point in time, what would end up happening is that the IRS would find an error and they would threaten to disqualify your plan, and then some sort of bargaining system came up that was very scary for everybody in the industry. So what EPCRS did is it produced an ability for the IRS to find mistakes and be able to help you correct them, or have you find mistakes on your own and have you correct them without everybody running around talking about disqualifying plans and making everybody crazy. So that's sort of the basis for how EPCRS came to be. And it came to be in little pieces originally. Different programs got put into place, but now it's all in one big omnibus program. Click. Thank you. So let's talk about first what having a qualified plan gives you. Generally speaking, what happens in a qualified plan is that the employer puts money aside for the employee, and that money will sit there and will earn interest and everything will get paid out at some later time. That's interesting enough, but the thing that makes qualified plans really hot are the 5 advantages that are shown on the screen. The first one is that the company makes contributions to the plan and is able to deduct them on the company's tax return. Well, the company deducts compensation anyway, so if the company paid you the money flat out, it would get the same deduction. So in absence of the other things that these plans do, the company would really not care one way or the other, okay? The second part, though, is what really makes these things powerful, and that's the fact that the employer makes the contribution on a deductible basis, and the money is not taxed to the employees until the employees actually leave and take their money with them. So what we have is a true deferral of tax. No tax is paid on the money at the beginning, and you have to wait a number of years before the tax actually is. It's really amazing. It's a very rare thing in any kind of tax situation to have that sort of time deferral of taxation of monies. The third advantage is that the funds that are held in the trust are tax exempt as well. So investment returns are not taxed. So the money is able to grow much more quickly. It's not suffering decrement every year by having some part of it taken away to pay taxes. Fourth, there are tax advantages on the distribution of benefits. Most importantly, the fact that they can be rolled over to another tax-exempt facility. So rather than having, gee, I terminated from this company, they want to pay me out my benefits, and I'm just going to have to pay taxes on them today, I have the ability of taking that money and moving it to another plan of my new employer, or alternatively to an IRA, and that allows me to defer tax even longer. So a non-qualified plan, once the money's payable, you get taxed on it whether you take the money or not at that point in time. This is exactly the opposite. You are able to defer taxes for an extensively long time. And then finally, the last part, which is really not a tax benefit, but it's a significant benefit, particularly business owners, is that the assets in the plan itself are protected from creditors. This is something called a spendthrift trust, which means that creditors of the participants or of the employer may not invade that trust and take your money. There are two main exceptions to that. One is the IRS can exercise a tax lien against the plan, and the second, of course, is a qualified domestic relations order, which is where a spouse or a former spouse is able to basically declare part of that money to belong to them as opposed to the participant. So those are the big advantages of tax qualification. Now, go ahead.
Yeah, we've got almost 1,000 people on the line, and after I change a slide, if you could just pause for 2 to 3 seconds to let everyone catch up, that would be great.
Sure.
Okay, and I'm going to move on now.
1,000, 1,000. Okay. All right. Now, what happens if your plan is disqualified? We use that phrase a lot talking to our clients, and lots of times people don't even know really what it means. Well, what happens is when your plan is disqualified, it is converted from a qualified plan to a non-qualified plan. And the effect of that is the following. First of all, contributions that are made to employees that are not currently vested are not deductible. So if I made a $100,000 contribution to a plan and 60,000 of it went into accounts that were not vested, I would only be able to deduct the other $40,000. The $60,000 part would not be deductible. To the extent that the benefits are vested, those would be taxed to the participant. So the $40,000 that I contributed that was put into vested accounts, that would be taxed through to my participants. So you'll notice that in this circumstance, there was $100,000 of contribution. Either I don't get to deduct it, or if I do deduct it, the employees have to claim it as income. So you see there's no deferral of taxation there at all. Secondly, the trust becomes a taxable trust. And so actually, this is thirdly. So the money that the plan earns during that period of time would be taxed at trust rates. Rollovers are no longer permitted because we're not deferring taxes now. We can't defer taxes down the road either. And in fact, if a rollover occurred during a disqualified year, it would be considered to be an excess contribution to an IRA account, and that would be subject to a 6% excise tax. It is possible, although not necessarily true, that creditors may be permitted to invade a plan that is disqualified. It sort of varies from jurisdiction to jurisdiction and court to court, but it is a possibility. And finally, if you're the plan sponsor, you have some potential exposure here to participants who would be rather annoyed that their qualified plan suddenly has become taxable to them. Change, please. So we talked about what a qualified plan is and the tax advantages. We talked about what disqualification is, what things can cause a plan to be disqualified. Well, the IRS has identified 4 types of boo-boos that they call failures that can cause a plan to be disqualified. The first one is called a plan document failure. And basically, the Internal Revenue Code requires that plans be written documents, and the IRS has interpreted that to mean that you have to have certain things in the documents to have a qualified plan. So if the IRS is requiring that something be in a document and it isn't there, that can be a plan document failure. Another possibility is if the IRS has said you can't do certain things in a plan and yet your plan language mandates that those things happen, that's something that's in the plan that shouldn't be, and that can also disqualify your plan. Second is something called an operational failure. And what that is, very simply, is because of the fact that plans have to be in writing, the IRS thinks, and I think this makes sense, that you should be following the terms of the written document. If you do something that is not what the terms of the document permits you to do, or you don't do something that the plan mandates that you do, that would be an operational failure, a failure to follow the terms of your document. Next slide, please. The third type of disqualifying failure is called a demographic failure. And what that is that your plan operates the way it's intended to. It operates according to the law. Everything's good, except for because of the demographics of your situation, you fail one of the tests that basically are tied to making the plan broadly based. So coverage testing, participation testing under Code Section 401A26, or non-discrimination testing failures. Those are demographic failures. Okay, again, you've operated the plan the way you're supposed to. You've done everything that you're supposed to. It's just that your demographics have caused you to fail on the testing in some fashion. And finally, an employer eligibility failure deals mostly with 457, 403B, and 401K plans. And what that is it's basically a situation where an employer is a sponsor of a plan that employer is not allowed to sponsor. For example, governmental organizations cannot have 401K plans. So if I was a governmental organization of some sort, I'm the fire department for a city or something, and I set up a 401K plan, I would not be allowed to do that. That would be an ineligible employer situation. Similarly, boy, I don't know why I'm having problems talking today. Similarly, if you have a non-tax exempt employer, they can't have 403B plans. So examples of disqualifying failures, the kinds of things that we see every day. Section 415 violations are where you put too much money in the plan for somebody. Uncorrected ADP or ACP testing failures is where a 401K plan fails its non-discrimination testing and doesn't fix it. Failure to give top-heavy contributions when you're supposed to do it. If you have a pension plan, you have to conform to the qualified joint and survivor annuity and spousal consent requirements, and if you don't do that, that's disqualifying. If you leave out people who should have been in the plan, or for that matter, include people who shouldn't have been in the plan, that is a disqualifying failure. If somebody's over age 70 and a half, or and has terminated employment, you have minimum required distributions you have to make, and if you don't do that, that's a disqualifying failure. Historically, the IRS has targeted certain things for audits, and we just thought we'd mention this to you here. These kinds of targets change all the time depending upon what the IRS's mood is, but historically we've seen that they targeted terminated plans that did not request or receive a determination letter. And what's interesting about that is that sometimes they audit as an audit target plans that do have a determination letter because they want to make sure you did everything you're going to say you were going to do. But usually if they're targeting terminated plans for something, it's usually because they didn't get a letter. Plans that are not funded properly. Plans that have a bunch of weird assets and they think that they have not been valued properly. Plans that have a bunch of prohibited transactions, which implies fiduciary breaches and other kinds of problems like that. They've targeted 401K plans and 403B plans, just those plans, for audit, particularly at times when they thought that those plans were not being administered correctly, or when they wanted to get statistics on errors, where they were found and things like that. Top-heavy violations have historically been an IRS audit target, and there was a period of time where the IRS was auditing SEPs, Simplified Employee Pension Plans, with quite a lot of fervor.
Okay.
Yes.
We've got quite a few more slides to go through already. Several minutes in, we're going to hold the questions till the end of the session to make sure we can cover all the slides.
Okie dokie. Even with me talking this fast.
Pardon?
Okay. Yeah, I know. I tend to be sort of like the guy who used to be on the FedEx commercial. I talk too fast. But we do have a lot to cover. Okay, so basically, EPCRS represents an alternative to disqualification. You made a boo-boo, you find the boo-boo, you don't want the IRS to disqualify you, so you fix the boo-boo, is really the whole thing to EPCRS. It was established in 1998. As I mentioned to you, in the 70s and 80s, we had all kinds of various different kinds of requalification and undequalification programs going on, and they grouped them all together into one program in RevProc 9822. And I got to tell you, I just can't believe how long it's been. It's been almost 20 years that we've been working with EPCRS, which just blows me away. The current procedure is RevProc 2016-51. And basically, if you do nothing, or if you, basically, if you do nothing, or if you do things wrong, your plan disqualification can stand. But the idea is if you follow what EPCRS has to have, then your plan will not be disqualified by the IRS. Next slide, please. There are a couple of things that changed in RevProc 2016-51. If you're on this session because you didn't know anything about the prior revenue procedure, this isn't going to be real important to you. But for those of you who are on the call that do know something about EPCRS. The updated procedure basically, for the most part, was there to conform all the stuff in EPCRS to the new favorable determination letter rules. There's been a lot of changes over the past year as to the way that the IRS deals with form qualification of plans, and the new procedure basically incorporated that. It used to be, there is a charge when you file with the IRS, and that user fee used to be part of the procedure, but the IRS wants to update it more often than updating the procedure, so they've taken the fees out of the procedure and put it in the procedure that ends in -08, which each year shows you what the user fees are for all the various kinds of things you can do with the IRS. It's basically the IRS's fee schedule. So nowadays, the user fee part of EPCRS is going to be as part of that fee schedule. They made some technical changes to the closing agreement sanctions, and they modified a little bit the unresolved anonymous submission issues. Not a big deal. Okay, EPCRS has 3 different procedures, and they're meant to basically involve 3 different types of errors, or 3 different stages of errors, I guess is the best way to put it. The first stage of error is called the self-correction procedure. And basically, if you have a very, very small error, or if you have an error that happened recently, you can fix it yourself in most circumstances. Sometimes there's a limit as to the time you can do it if it's significant, but basically that's the do-it-yourself part of EPCRS. And if you can fall within that, that's the easiest and least expensive way to deal with things, because you're not dealing with the IRS at all. The second possibility is for some reason the self-correction procedure doesn't work, and you want to voluntarily go to the IRS and sort of, pound your chest and say mea culpa and fix it and be blessed going forward with all of your sins being washed away. That's the voluntary compliance program, which is usually called VCP. And then finally, if the IRS audits you and they find a mistake, they give you a last chance to work with them to negotiate a correction of the mistake and a sanction, and that's called the closing agreement program. All of these programs have certain correction principles that underlie them. These are the things that the IRS has said is important to them when you're framing how to fix things. Okay, and the correction principles generally are, first of all, that the correction should restore the plan to the position it would have been in had the error not been made, which means that participants have to be made whole. And it also means that to the extent that time has passed between the time that money should have been put in that participant's account and the time that you actually fix it and put it in there, well, you have to pay interest on that amount of money. So all the corrections that you do, if you have to put money in the plan, there's going to be an interest element to that money. Secondly, the IRS likes it best if you leave money in the plan. So they don't like solutions that involve necessarily distributing money out rather than leaving money in the plan. There are times where you have to do that, but that isn't their preference. Next slide, please. Operational errors, again, the ones where we're fixing things to look like what the plan says, you have to take into account the plan terms the time that the error was made. So if you did something in a certain way and your plan required that you do it another way, the most common fix is going to be to do it the way the plan said to do it. There's some variations on that, but that's going to be basically the underlying principle of what you're going to do. The correction should be reasonable and appropriate for a given failure. One of the things that's really important about EPCRS is that there is no one correction for any error. There are times where you can discuss with the IRS either through CAP or, either through the VCP program or just on an informal basis, gee, this correction that we would normally do for this just doesn't work for us for some significant reason. Is there another way that we can correct? And we do this a lot for our clients. It's to try to find some of the alternate ways that will meet their needs a little bit better. And the procedure lists factors for determining if a correction method is reasonable and appropriate. Next slide, please. Basically, if you're going to have to make corrective allocations or corrective distributions, they have to be based on the terms of the plan. As I mentioned before, they have to be adjusted for earnings. And usually the source of those additional contributions and earnings is going to be new employer contributions, or if forfeitures are used to reduce employer contributions, they can commonly be used for corrections. If a forfeiture is supposed to be reallocated to people, you may not use those forfeitures for corrections. And then the final thing on this slide, which is really important, is that the IRS's point of view is generally that full correction has to be made for all years. So if you've got a problem going back 25 years, you're supposed to fix 25 years worth of corrections. Again, you might be able to finesse on that a little bit, but that's what the procedure says. If someone was overpaid or they made an excess deferral that needs to be distributed, then it's important to note that those excess amounts are not eligible for rollover. And if somebody rolled it to an IRA, then they are subject to the IRA contribution limits, and to the extent that they exceeded that, there's an excise tax. And the plan sponsor must provide the participant with a new 1099-R showing the correct distribution. So if I got a payment of $1,000 and it turns out that they should have only paid me $900, then they have to give me a new 1099 that says, okay, $900 was rolloverable and $100 was not. There are some exceptions to the correction principles. First of all, generally speaking, first of all, in order to use some of these exceptions, you have to demonstrate to the IRS that there's no significant adverse effect on participants and there's no significant discrimination in favor of HCEs. So if you want to go to the IRS with an alternative to the correction principles, you need to be able to show that, look, this is going to be okay for the participants. We're not hurting anybody on this, and we're not putting a ton of money in the pockets of our HCEs. It's sort of a neutral kind of solution that we want to use for some other reason. An important aspect, because this is always where people want to go, is that if you go to the IRS and you whine that you can't do a correction because it's so burdensome and you've got so much data you got to get, and oh my God, we have to look through files for years, they have no sympathy with that. Okay, so you never want to be going to the IRS and talking to them about how you can't make a correction because your records aren't good enough. They just have no sympathy with that whole burdensome comment. That might allow you to modify some things, but they generally don't. They just don't take that well. They just couldn't care less. Okay, you're allowed to use estimates if the cost of precise calculation outweighs the probable difference, or if a precise calculation is not possible. So there's an area where the IRS will let you do some stuff because you can't get to those records. If you have to make a corrective distribution to somebody of a small amount that is less than $50 or less, and if the cost of processing that distribution exceeds the amount that the person is going to get, you don't have to make those distributions to the people. And you have to take reasonable actions to locate lost participants and beneficiaries, and those initials, which are the sort of a thing that Tim does, stands for, what would you do if it was your money? Next slide, thank you. There are some areas where EPCRS is not available. Generally speaking, if there are other corrections that are in the code or the regulations outside EPCRS, you are supposed to use those and not EPCRS. And generally speaking, EPCRS is not available to resolve tax problems or excise tax problems, with the exception of the ones shown on the screen. These ones, if you do a filing with the IRS and you specifically ask for the waiver of those excise taxes in connection with the corrections that you're doing, the IRS will generally grant that to you. But if it's a different excise tax, you really can't go into EPCRS for that.
Yeah, and two of the notable ones that aren't on there are the 4975 prohibited transactions and the minimum funding excise taxes.
That's correct. Okay, so let's talk about self-correction, which again, no IRS involvement, no fees, no problem. Okay, so and this is the do-it-yourself procedure. Basically, if you read the rules, it says that these are for operational failures only. In truth, I will tell you, everybody uses it also for demographic failures. And when you're doing that, quite often what you're doing is you're using a regulation section, which is Regulation 1.401A4-11G3. Which basically says that if you have a demographic failure, that you're able to do an amendment after the end of the plan year to fix it by giving more money to your non-highly compensated employees or including people in the plan that weren't supposed to be included. So quite often you're just doing that after the normal deadlines or something, but you usually can do that within self-correction. Only limited corrections can be done by plan amendment. One of the things that you'll hear us talk about off and on throughout this session, and definitely in the next session, is that the rule that the IRS usually follows is they want you to match what the plan did to what the plan says. There are going to be times where you'd rather change what the plan says to match what you did. That's a correction by plan amendment. That is not looked upon very favorably by the IRS, but they let you do that in certain circumstances, but only in a very limited fashion under self-correction. Generally speaking, if you're going to do an amendment to fix your plan situation, you've got to tell the IRS about it. You cannot correct egregious problems in the self-correction procedure. Basically, that's a real facts and circumstances thing. I've never seen the IRS raise this issue to me, but theoretically, if you had a plan, for example, that was putting in tons and tons of money for your highly compensated employees that was exceeding every limit the plan has and doing nothing for your employees, that would be an egregious failure. In order to do self-correction, first of all, you have to have a plan that is the subject of a favorable determination letter. For a pre-approved document, it means that there is a current opinion or advisory letter on that pre-approved document. So if the last time you restated your plan was ERISA, but you did it on a prototype document, that's not enough because your plan does not have a current opinion or advisory letter. That advisory letter expired years and years ago. So we're talking about for defined contribution plans right now, if you have a pre-approved document, you need to have a PPA opinion or advisory letter. For defined benefit plans, they don't have their PPA letters yet, so you're talking about the extra letters. If you have an individually designed plan, generally speaking, you either have had to have had a favorable determination letter at some time in the past, or alternatively, if you have a new plan, it doesn't say this specifically, but I'm sure it's true that if you're in the process of applying for a determination letter, that would be satisfactory. In light of the new determination letter rules, some people may be thinking that they're not going to apply for a letter at all, and I think it's important for them to know that if that's the case, they will not be able to take the self-correction rules under EPCRS and apply them. Additionally, a plan has to have established practices and procedures. This can be formal or informal, and basically what it is it's the stuff that tells the employer what they're supposed to do about the plan. Now, historically, what we used to say to the IRS is, hey, they've hired us. That's their procedure. They call us, we tell them what to do. That's not enough for the IRS anymore, okay? They want to know that this client has some procedures that were in place and they just messed up on those procedures somehow. So one of the things, this is just a footnote for you to think about, as a plan administrator or a plan service provider, you might want to think about helping your client establish some somewhat formal practices and procedures so that in the event you ever want to go into EPCRS, that you can demonstrate that you have established practices and procedures. Next slide, please. Now, if you have an insignificant failure, you can correct the plan at any time, including if it's under audit. So let's say that the IRS is auditing your plan and they find out that you have one participant out of 300 participants, and you transpose the number in their compensation so they got under contributed by $12 out of a $1 million contribution, okay? That's clearly an insignificant failure. The IRS will tell you, hey, you messed up on this one person, please fix it, and it won't become a big deal. Nobody's going to threaten disqualification in that circumstance. So the IRS quite commonly will offer you self-correction without charging you a sanction if they feel that the issue is insignificant. What constitutes insignificance? Well, again, it's a balancing of factors, so it's nothing definite. But basically, the factors the IRS looks at are whether any other failures occurred, what percentage of plan assets and contributions are involved, how many years did the failure happen among, how many participants are affected, and they look at that as a straight straight count of participants. 10 people were affected, and also as a percentage of the total participants in the plan who could have been affected by the error. So in other words, I may have 100 participants, but 3 took distributions and we messed up on all 3. That's not as good a fact as if we had 10 people who took distributions and we only messed up on 1 or 2. Was the correction made within a reasonable time after it was discovered? Did you discover it back in 1904 and dawdle around on fixing it until you knew the IRS was at your door? Or did you try to do things right away to make the plan correct? And finally, how did the failure happen, or why did it happen? A significant failure is anything that's not insignificant. That was really helpful. Basically, if you feel like it's not a teeny tiny error, that would be a significant failure. Significant failures are time limited. You are allowed to correct a significant failure up to the last day of the second plan year following the year of occurrence. So let's say that we made an incorrect payout today, April 11th, 2017, on a plan that's a calendar year plan. We would be able to self-correct that mistaken payout anytime up to December 31, 2019, the second plan year following the year of occurrence. And if we did that, that would be considered to be a self-correction, okay? If we went after that, technically, we're not allowed to self-correct if it was considered to be a significant error. Now, when you are doing non-discrimination testing on a 401k plan, you have a year, just by virtue of the law, to fix an ADP or ACP failure. So your self-correction period starts at the end of that year that's provided for in the code, which actually allows you the third plan year during which you can make a correction. So let's say that we failed non-discrimination testing in 2017 or for the 2017 year. We would have 2018 to fix that 2017 failure under just the code, and then we would have 2019 and 2020 during which we could fix under the self-correction program without having the plan disqualified. Did you want to say something, Tim?
Nope, nope.
Okay, all right. And finally, if you have a significant failure and you get audited before you get it corrected, the IRS audit cuts off the self-correction. Now, because we don't know exactly what's insignificant and what's exactly significant, it's always best just to get every correction done within that 2 or 3 year correction period, because then you know that no matter what you agree with or disagree with the IRS as to the significance of the mistake, it's corrected within the self-correction period of time. So I don't even look at the significance of the issue unless I'm outside the self-correction period, because I know I can fix it during the self-correction period one way or the other. It's only after it goes past that and a client calls me and says, in 1974, we made this mistake, do I start looking at whether or not I can argue that it was an insignificant failure. What constitutes substantial correction? In order to fall within that 2 year period, you have to have the error substantially corrected. You don't even need to have full correction. It just needs to be substantial. And substantial correction is defined as either that you promptly identified the error and you formulated the correction and you initiated correction in a manner that demonstrates that you're trying to get it done expeditiously, or alternatively, you would demonstrate that you completed the correction with regard to 85% of all participants and that you're diligently completing the correction for the rest. As I mentioned before, there are a couple of things you can fix by plan amendment. The two bottom ones are the ones that are most common. You have a situation come up where somebody takes a hardship distribution or somebody takes a loan, and lo and behold, your plan doesn't allow for hardships or loans. You are allowed to amend the plan retroactively to permit the person to take the hardship or the plan loans. Same thing, we let somebody in early. We have a 1 year wait on the plan, and I don't know what happened, but we let Joe in after 6 months. You can amend your plan to change it to a 6-month eligibility. Now, the procedure lets you make those changes just for the people that you made the boo-boo on, so long as that does not result in impermissible discrimination. So if you let in the CFO early, that's going to be a problem. But if you let in Tom and Jane and Sue, who are all not highly compensated employees, you could do an amendment saying we're just going to let in Tom and Jane and Sue, and that's it, and you'd be fine doing that. Okay, moving on. VCP is the negotiated voluntary correction with the IRS. So you're dealing with the friendly IRS in this circumstance. You're going forward. You're saying we made a mistake. Work with us. We'll try to fix it. And the IRS has a lot of stake in trying to help you fix these things. So they want people to do this. The IRS acknowledges they can only audit about 5% of the plans out there. So the only way they can keep plans in compliance is if they encourage people to do it themselves. So they want to work with you in VCP. So what you do is you make up a whole package, you submit it to the IRS for review, you negotiate the correction process. There's a set user fee based on the number of participants in the plan. And for some of the errors, there are reduced fees that can really help out. And everybody goes home happy. You get a letter from the IRS saying that you've done this, that you can flag it to any auditor in the future, and they respect that. To go into the voluntary correction program, you cannot be under examination at the time that you make the submission. And under examination applies only to the plan, not to the company. So the company can be under audit, but if the plan is not, you're not under examination. So under examination means you're actively under audit by the IRS. You've received verbal or written notice that an audit is forthcoming from the IRS. And then also, if you have a plan that joins with another plan in your company to meet certain requirements, then you are considered to be under audit if that other plan is being audited for one of the things that you're meeting jointly. When do I see us using VCP? Well, the first place that we use VCP commonly is when the self-correction period's closed. We have a mistake, we're worried about the mistake, we've got a client who really likes to be in compliance, and it's too late to self-correct, we go into VCP. The second reason why we might go into VCP is that we don't know whether or not the correction method we want to make is something that would be acceptable to the IRS. If you do a correction and it's not acceptable to the IRS, you've probably done a second violation, so you've made things worse. So rather than doing that, we submit under VCP so that we can go through the procedure of talking to the IRS about the correction, and the IRS can tell us whether they would accept it or not. Third is the failure's not operational. Remember, we can only correct operational or maybe demographic failures in self-correction. If we've got a plan document problem, we didn't restate for PPA, or we didn't restate for ERISA, or whatever it is, or we wanted the plan to have a 50-cent match instead of a 25-cent match, and we never did the amendment. Anything that causes a problem that involves something that's not operational, we can't correct in self-correction. We've got to go to VCP. Anytime, except for the 3 times I mentioned earlier, that we want to change the plan to match what we did, instead of matching what we did to what the plan says, we need to use VCP. And finally, the other area where I find it's used a lot is that I'm selling my company and the buyer knows that we have a problem in our plan and they want to make sure that that's corrected, that they're not buying a pig in a poke. So the general procedure, the steps that you go through, is that you file it with the IRS, you pay a user fee, you chit-chat with the IRS as to the correction method. The IRS will issue a compliance statement with the agreed-upon correction in it, and you have 150 days to comply with that compliance statement. If you can't comply within the 150 days, you can ask for an extension. But if the 150 days passes before you correct, it's too late. The correction by plan amendment, as I mentioned, it can be a plan document, demographic, or operational failure. It is not favored for operational failures. Usually what you have to do is you have to prove to the IRS that there was an error in the documentation and that neither the employer nor the employees had any real expectation of getting what the plan says versus what they thought they were getting. Again, you have to show some proof about that. It's a much more complex process, but sometimes you can get it through. Next, please. There we go. This is my favorite clip art of the entire program. I just love this guy. There is a process under VCP where you can actually submit anonymously. Let's say that the IRS normally approves a correction of whatever my error was by making an additional contribution to the employees. And we have so many employees that are affected and so many years under which they're affected that the expense for correction is like $400,000. And there's no way that the employer can afford the $400,000. They just can't do it. So what we want to do is we want to approach the IRS and ask for a different correction that would reduce the cost down to $150,000, which is a number our client can afford. Now, if we just go into the regular program and we submit and they know who the client is and the client says, I can't put in the $400,000, and the IRS says, well, we're not going to accept anything else, then what's going to happen next? I mean, the IRS is going to pull the guy for audit if he refuses to do it, and he's going to have to do it anyway. So that's a scary thing. That would keep a client from applying. But if the IRS would accept the $150,000 alternative, my guy's willing to go in and do everything. So what we do is we do an anonymous filing. Again, what we do is we fill out all the forms and we do the whole submission, but we don't show who the client is. All we show is that it's me, the representative. Send it into the IRS looks at it, we negotiate the settlement. If the IRS accepts our $150,000 alternative, we then tell the IRS who the client is, the bag comes off the head, and we move forward through a full VCP filing. If the IRS says, yeah, we're not going to work with you, he's got to put in the $400,000, we can just go quietly off into the moonlight and hope that my client doesn't get audited by the IRS just by chance. And then the IRS will never know who that client is.
Yeah, there's a couple of other situations where you might want to look at it, and that is if you have a large amount of excise taxes, such as a missed acquired minimums, where the excise taxes can get very large. The IRS rules say that they may waive the excise tax. It's not automatic. So if you have a situation where there's a large amount of excise taxes, you may really want to look at this rather than just going in and saying, and just thinking that they're automatically going to waive them. That's not the case.
Okay, next slide, please. Okay, so as I mentioned, the representative will submit the VCP with the redacted documents. If the agreement's reached, we have 21 days to disclose who the client is. If agreement's not reached, we just fade away and we move forward and hope we don't get caught. There's also a program for group submissions. This applies to a situation where, say you're a TPA, and let's say that you use a given software to do your ADP testing. And lo and behold, you find out that there's a problem with the software, so that there's some percentage of every client that you have that would have done the testing incorrectly and would have looked like they passed ADP testing when they didn't. You can basically do this big group submission to the IRS dear IRS, we have this systemic problem, and we messed up all these people's ADP tests, and we want to fix them for one big, settlement. And the IRS will do that for you. You have to disclose the problem to the plan sponsors. You're not allowed to just try to, slip it in, and they won't even notice. And the fees actually are pretty inexpensive, even though they look kind of big on the thing. It's $10,000 for the first 20 plans, which if you had 20 plans, that's $500 a plan. That's not so terrible. And then $250 for each additional plan, up to a maximum of $50,000. The VCP user fees are normally those shown on the screen, and you can see that for a plan that's got 20 or fewer people, the IRS charges you $500, which is really chump change when you think about disqualifying your plan instead. Over $10,000, the fee goes up, or 10,000 participants, the fee goes up to $15,000. Again, that's not huge money to somebody who's got that large a plan. There are lower fees available for certain things, like if you have a failure to do the required minimum distributions, or if there's a loan mistake. Certain non-amender situations, the fees can be less, particularly if you find the error within 12 months of the end of the remedial amendment period. If you didn't get a favorable determination, or sorry, if you got a favorable determination letter and you forgot to do the amendment it required, as long as you fix it within 3 months, it's $500. And yes, I know there's only one M in months. I missed that correction. And then the VCP only contains non-amender failures. Like I said, it's 50% if you do it within a year. There are also a potential increase in fees for egregious errors. Again, I want to make it really clear, I've never had a situation where this came up. But if you actually had a super, super egregious situation, the IRS can come back to you and say, yeah, we're going to treat this like it was really an audit, and we're going to hit you with a larger fee. And then they will negotiate that fee because you did come in voluntarily. But they theoretically can come back and say, we're going to charge more than the user fee. As I mentioned, the IRS has huge interest in making sure this program stays happy. So I've never seen that happen, and I don't expect to. Next slide, please. Okay, finally, the third program within EPCRS is the audit cap program, and that's when the IRS fines you. And so they find a disqualifying error. They don't want to disqualify the plan, and they want you to negotiate with them to fix the error. And what will end up happening is you will enter into a contract with the IRS, which is called a closing agreement, which says, we, the IRS, are not going to disqualify your plan in return for you making this correction and paying us some money. And that money is called a sanction under the CAP program. It is a negotiated amount under the facts and circumstances, and there are some factors the IRS identifies. The procedure itself says the sanction cannot be excessive and has to bear a reasonable relationship to the nature, extent, and severity of the failures. I will tell you that there have been times where clients of mine really get upset because they think that the sanction is too high, but you rarely see a sanction over $20,000 or $25,000. Now that sounds like a lot of money, but I've only seen those rarely. I mean, usually the amount of money I see the IRS charging when we get done with our negotiations is something that's high enough to sting the client, but not high enough to put them out of business. I mean, they're going to feel the pain, but it's not going to kill them. So the factors are things like the steps taken by the plan sponsor to make sure that the plan had no failures. Was your plan sponsor basically compliant in general? Steps taken by the plan sponsor to identify failures that may have occurred, the extent to which the correction process had progressed before the audit began, the number and type of employees affected, and the number of NHCEs that would be adversely affected if the plan were disqualified, whether the failure related to non-discrimination or plan coverage, which are the big ticket items for the IRS, whether there was an employer eligibility failure, the period during which the failure occurred, was it just this 1 year, was it multiple years, why the failure happened, and the taxes that would be paid if the plan were actually disqualified. That last factor used to be the first factor that they looked at. Nowadays, they're just looking at that as one of the many factors. If your plan has been involved in or if you as a company have been involved in a transaction and have taken in that plan and merged that plan with your plan, basically, if you can show that the error that happened in the plan that merged into yours, the IRS will only look at the assets of the transferred in plan to determine the sanction. So they won't. If you have a situation where you've got a plan that's got 10,000 employees in it, and you bring in an acquired plan that has 10 employees in it, and you stick it in your plan, and it turns out the IRS finds a disqualifying failure in that 10-person plan, they won't look at this big plan to figure out the sanction. They're going to look at that 10-person part of the plan. So that was about the fastest, whatever it is, 50 minutes I think that you've ever spent on EPCRS. As we mentioned, we will be doing part 2. At that point, we're going to talk about some of the corrections to specific errors that the IRS has published, strategies for VCP submissions, strategies for CAP negotiations, when you need a lawyer, and some of the other tips of our trade. so. And August 3rd at 2 o'clock is when that session is going to be.
And I think next we'll take some questions, and then after the questions, we're going to do a quick demo of Chapter 21 of the Qualified Plan E source, which is authored by Ms. Ferenzi, and we'll give you an overview of how that's organized. It's basically organized in the same fashion as the webcast. So stick around for that if you're interested, but right now let's take some questions.
Great. We do have some questions from the audience today. So the first one is, would a company that sponsors a simple IRA and 401k contributing to both in the same year be an eligibility failure?
That's a really good question. You know, I'm not sure of that. Well, there's two ways we can handle this. One is that the person who wrote the question can send me an email, or they can identify themselves to Joanne, and I'll get you the answer on that, and I'll get it back to you. I honestly don't know. That's a really good question.
And I do have that information here, and we can do that. Next question is, how does a 1099-R show if a distribution is not rolloverable? I'm not sure that rolloverable is a word, but we'll go with it.
I think it's a word.
Okay.
I think it's a word. Rolloverability. You know, consider it anyway. Basically, what happens is that there are two boxes on the 1099-R, the way I understand it. And you'll forgive me because I don't do 1099-Rs anymore. That's why I don't do administration anymore, as I hate 1099-Rs. But seriously, I believe there's a box that talks about whether or not it's an eligible rollover distribution, and another box that says it's another type of distribution. So to the extent that you had an amount that was not entitled to be rolled over, it would not be part of the eligible rollover distribution box.
Okay. Next question is for SCP, self-correction. Let's say a cash balance plan did not obtain a favorable determination letter, but is restated on a pre-approved PPA document that permits, then would this be eligible for SCP?
Okay, we have a problem with that because, of course, you're not allowed to have cash balance plans on pre-approved plan documents yet. So what we would have to do is we have to look at that circumstance. If they adopted onto this pre-approved document after the IRS announced that they were going to be doing pre-approved cash balance plans, we might have some reasonable argument that we are just waiting for this document to be updated, and so we are technically the subject of a determination letter. If, on the other hand, we have a cash balance plan that goes back a really long time, and we just now put it onto this prototype document or this volume submitter document, which, by the way, was not approved to have cash balance provisions, and I think that we would have a problem, and we would probably want to wait until you did get on a pre-approved document.
Okay. Next question. I think this is a good one. If a plan does not allow for loans and a loan is given only to an HCE, if that ever happens, may you still correct with amendments?
I'm shocked, I tell you, that there would be an error that was made just for an HCE. I've never seen that before in my life. Seriously, there is a whole procedure for correcting loans that you can use. The procedure is slightly different when it involves only HCEs. The main thing that I will mention today is the fact that you're not going to be able to do an amendment that will just purify that one loan. So remember, I mentioned that if you have people coming in that weren't supposed to come in, or people who are taking loans or hardship distributions that weren't supposed to, that you're allowed to do an amendment so long as it's not discriminatory. That will only approve that process for the people that you did it for. When the person that you did it for is just an HCE, then that would be discriminatory. So you have to know that we're going to open up loans for everybody from now on. And then if you do that and you use the VCP program, then you would be able to move forward on that basis, and it would be correctable.
Yeah, and I think the standard that you would use would be if giving the loans to that group of people would be a benefit right and feature that would pass testing.
I absolutely agree with you, Tim.
Okay. Another question, perhaps for both of you, as far as an opinion. Do you have any thoughts or opinion on the proposed cuts to the IRS budget?
Well, I think that it's interesting because this sort of goes for the reduction in regulations unless you get two other regulations taken away in order to have one. on the one hand, we all like it when the government is not in our hair. And so the idea is that if you have less of a budget at the IRS, you have fewer auditors. And if you have fewer auditors, then they're going to bother us less. The problem also is, though, is that when the IRS's budget gets cut, we also lose some of the stuff that helps us from the IRS, like regulations that tell us things that are currently vague, or procedures that let us do things that we weren't able to do before. So, you know, I have real mixed feelings anytime they cut the IRS's budget, because we need to deal with them, we need to work with them. But probably, at least in the short run, it's not such a terrible thing. What do you think?
And I would think that just solely looking at it from our point of view in our industry, it's not a good thing. I mean, I'm not going to comment about the broader economic things, you know, but just focusing on our lives, you know, you've seen the cutbacks in getting favorable letters. You know, all of that is due to the fact that the IRS just doesn't have the money.
Yeah, good point.
And do we have time, do you think, for one more question?
Sure.
Yeah, I think so.
Okay. If a client overfunds a participant account, in other words, calculates match incorrectly, and needs to pull back the ineligible contribution, are there any hard and fast rules in pulling back those earnings?
Well, first of all, if the participant suffered a loss, you don't have to pull back earnings, and you can pull back the negative amount, or the, let me rephrase that. Let's say I put $100 too much in that person's account and the person has lost money, so $100 is now equal to $98. I could pull out the $98. The problem that comes up every so often is, particularly in a participant-directed investment situation, is let's take this to the extreme. Let's say the person who got too much money lost money, and the person who didn't get the money that was supposed to was invested in stuff where they doubled their money. Okay, so what we have here is a situation where the $100 went to the guy, is now worth $98, but had it been in the right guy's account, it would be worth $200. Well, we can't take $200 from the guy whose money we put in incorrectly because it wasn't his fault. So what ends up happening is we take the 98 out of the guy who got the money, and then the employer is going to have to contribute the difference between the 98 and the $200 that the right guy would have received had his money been in the plan. So there's a certain amount of again, finesse that you have to do when you're calculating earnings for people. There's also other things that happen if you can't show what happened. What can I do if, you know, everybody's invested in different stuff and there's no way for me to know how much money would be earned by everybody? There's all kinds of procedures and efforts that help you calculate that dollar amount. But hopefully I answered that question well enough that it gave the person what they needed.
Now we have several other questions which I'm recording right now, and what we'll do is I've noted to some of the participants is that we will get back to you with answers on your questions.
Okay, so thanks everybody for attending, and we did do some questions. I think we've got some more to follow up on. There's a slide up here now talking about your CE credit. You should receive a certificate by email in just a few days. ERPA does take a little bit longer. There's a different process to go through there, so please be patient. Also, as we found out with some of these invitations, please check your spam folder. Some things do get caught up. If you have any questions or are missing something or you just can't find it, you can always email us at support@erisapedia.com. Again, here's Tim and Eileen's contact information. We'd be glad to talk to you guys and help you individually. Eileen if you can hang around, you'll see chapter 21. I'm going to give you a real quick look at what's in chapter 21. A lot of really good content that Eileen's help us put in there with specific correction for failures, which I'll show you a couple of those. So I think that's it. So we're just going to wait a couple minutes here, let people who need to leave, and then those of you who hang around, we'll just give you a quick 2-3 minute look at chapter 21 in the qualified plan e-source. I think you need to make me presenter, Tim.
Okay. Okay. There you go, Chuck. You should have it.
I have the power. All right. So we'll just wait another minute or two and get started. quite a few people still in the room. That's awesome. What you're seeing on the screen right now is the main interface to Aristopedia.com. I'm already logged in. These are the products that I subscribe to here on the left. You'll see government source material as well as all the individual treatise products we have written. And we're going to look at this qualified plan e-source real quick and specifically look at Chapter 21, which deals with plan corrections. Okay, so again, here we are at the start screen for Aristopedia.com. I've logged in. Typically, what a lot of people do who use our product is they just open the book and they look for a particular chapter. In this case, I know Chapter 21 talks about plan corrections. I can just open up Chapter 21, and I can even select and open up the table of contents. What Tim and Eileen just spoke about was very much all of this here at the top of the table of contents. So all the way down to, don't go too fast, submission of determination letters. So a lot of that is what we covered in part one, which is sort of the fundamentals and the basics of the plan correction concepts. A little bit about that RevProc. As they noted, both of them said the revenue procedure is not particularly well organized. Okay, so what we've gone further to do is break down and separate out the individual types of failures, non-amender failures, eligibility failures, 415 failures, and as somebody mentioned here, loan failures. Couple of things you'll notice when you skip directly to that section of the chapter is oftentimes we have a link right to the form, and when you click on that link, it just opens up the blank form for you to use to start the correction procedure. So you'll see all throughout here there are links to EPCRS sections, there are links to code sections, it could be a revenue ruling, revenue procedure, what have you. And anytime you click on any of these links, we just open up another tab up here at the top of the page. So I've got my table of contents here, I've got my section in Chapter 21 I was reading, and now I'm reading this particular revenue procedure out of EPCRS. I can go back to what I was reading. I can leave these open and move around, so that's kind of helpful. At all times, the search bar is available. So for instance, if I really don't know that I need to look in Chapter 21, I can actually just come to the search bar and say, where do you guys discuss VCP? And once I hit search, you'll see a lot of the hits are in Chapter 21 because that's where VCP is covered. What you might want to do, since you can see we have 63 results, you might want to say, what I'm really looking at is VCP fees. So now when you run that search, instead of 63 results, we've gotten to the specific 25 where VCP fees are discussed. Again, that could be found by just kind of scrolling through the chapter, but the search bar is sort of my quick way to get to certain things. If you're a current customer, we appreciate your business. We hope you can find more value in understanding kind of some of the stuff that's in these various chapters. If you're not a customer, we'd be glad to give you a quick demo to show you sort of the functionality that I went through very quickly. And if you need any help with any of the content or the system, please let us know. Again, sales or support at Aristopedia.com. We'd love to talk to you and help you. Again, write us at support at Aristopedia.com if you'd like to have your own personal demonstration of the product. We appreciate you all attending the session. It's just now over an hour. I think the first 50 minutes was very valuable. I learned a lot. Hopefully you did too, and we'd appreciate your comments or thoughts. Thanks for attending, everybody. Have a great day.